All right, let's continue with our discussion of merchandising transactions. This first slide is not too terribly terrifying or even important, really. All this is saying is when we're talking about sales transactions for a merchandiser, we're likely, instead of using the term that you've been familiarized with, fees earned, a little bit more likely to use a term like sales or sales revenue, something like that. So all this slide here, all we have here is we have a situation where we have sold some merchandise. We've sold that merchandise for $1,800 and we received cash. So our journal entry is strictly a debit to cash for $1,800 and a credit to sales for $1,800. If this was a service-related business that we've been studying, the only difference we would have here is that instead of saying sales here, we might say something like service revenue or fees earned, something like that. So again, a very subtle difference, not too big a deal at all, really. So let's move on. But because we are dealing with a merchandiser, we don't have strictly one debit and one credit taking place. So let's see what we have here. It says, using the perpetual inventory system, the cost of goods sold and the decrease in inventory are also recorded. Okay, so still talking about that transaction, we sold merchandise for $1,800, but again, it was merchandise, it wasn't service. So let's say that our cost of goods for that merchandise is $1,200. Well, the entry to record the cost of goods sold and the decrease in inventory, because remember, we don't have that inventory anymore, would be as follows. Cost of goods sold is an expense account, okay? It doesn't have the word expense on there, but cost of goods sold is most definitely an expense account, therefore it is debited for $1,200. Inventory, which is an asset, has gone down because we sold it. Therefore, it is credited for $1,200. Now, I will say this. You could make this all as one entry. You could have cash up here as a debit and cost of goods sold as a debit, cash for $1,800, cost of goods sold for $1,200. Then you could have a sales credit for $1,800 and inventory credit for $1,200. You could do all of that in one transaction. But because this is an introductory level class, we're splitting this up to kind of help you take this in pieces a little bit, okay? So if you see these journal entries done a little bit differently, elsewhere, maybe on the internet or something like that, don't think that that it's incorrect or that this is incorrect. It can be done either way. Okay. All right. So, need to bring up a couple of things about here. The point of this slide is how a business handles processing fees when customers pay with either debit cards or credit cards. Okay. But I want to say something else too. It says here, sales made to customers using credit cards such as MasterCard or Visa, these sales are recorded as cash sales. Now, the only reason I'm bringing this up is because I want you to understand that whenever you go to the well, let's just use our example of the $1,800. And it said cash, we're crediting cash for $1,800. I'm sorry, we're debiting cash for $1,800 when we sold the stuff. That may very well have been a credit card transaction. Okay. But even though we didn't actually get Federal Reserve notes, cash, we're still going to record that as a cash transaction. So we're not setting up an account receivable when somebody pays with a credit card. Then later what we're going to do is, as we're charged the processing fees, if you go to the store and the furniture store and you buy furniture for $1,800, for example, when they swipe your card at the furniture store, they're likely to get charged, say, 25 cents, 20 or 25 cents just for swiping the card. And then there's going to be some percentage, say 1% or 0.5%, that credit card company will take. So we're gonna let me show you how we do that. We're going to record that transaction as an $1,800 sale, and then periodically, usually a couple of times a month, the credit card companies will go in and they'll hit our business account for the fees associated. And so we treat these fees just as a regular operating expense. We don't adjust sales or anything like that. So if we sold it for $1,800, and let's just say that we had $10 in total fees associated with that transaction, we're not going to record that as $1,790. We're going to record it as $1,800, and then looks like maybe once a month that credit card company is going to go through and they're going to say, okay, well, you owe us $10 and $22 and so on, and in this case the total is $4,150, and they're just going to take that out of our account. Okay, we probably sign an agreement with them allowing them permission to do that whenever we set up our credit card terminal in the store. But that's okay. The idea is, hey, you know what? This $4,150 here that I'm paying in credit card expense, you know, I've probably increased my sales tenfold just by taking credit cards, so it's okay. So here's a journal entry for that. We've got credit card expense. Remember, expenses are always a debit. They're taking our cash for the privilege of processing those credit transactions, so cash went down with a credit. Okay, so this just becomes a normal operating expense for the business. All right. So if you will keep in mind, we are using the accrual basis of accounting. That means that we are going to have a lot of these estimates. Estimates run rampant through accrual basis accounting. So when we make sales, we have to accept the inevitability that some of those sales are going to be returned. Just like Net Solutions returned those 10 computer cards, whatever they were, for $90 a piece. Okay, so here we have a company. What is this? Glibney Company estimates annual sales of $400,000, and that 3% of all merchandise will be returned by customers. Further information, the company has an average selling price of $10 per unit and an average cost of $5 per unit. So they're going to do two things so that the financial statements are as fairly presented as humanly possible. So the first thing they're going to do is that they're going to take an immediate hit to sales. See, sales has a normal credit balance, right? In this example here, I just pulled this in from Excel. We're debiting sales for $12,000, and we're setting up an account called, looks like misspelled customer there, customer refunds payable for $12,000. That's our liability, and our explanation is to record liability of 3% of estimated $400,000 in sales. You know, so if our sales end up being $450,000 and 3.5% of the merchandise gets returned, well, this $12,000 estimate is not going to work out exactly, but that's okay. We're trying to be fair here. Remember, faithful representation, that concept we learned in chapter 1. This is a part of that. Also, we're going to do the exact same thing. So what we're doing here is we're curtailing our revenues some, our sales revenues, but we're also going to make an adjustment for inventory, which is an asset. So this is faithful representation, and it's also a concept in accounting called conservatism. We're also going to estimate inventory returns, and we're going to set up a contra asset account for $6,000, and we're going to go ahead and credit $6,000 of inventory. Why 6,000? Because notice our cost is per unit is half. So our inventory cost per unit is $5. Our selling price is 10. So if we have sales returns of $12,000, the inventory that generated that 12,000 cost us 6,000. Okay, so we're going to go ahead and credit inventory right off the bat so that our inventory is not overstated. Okay, we're going to have some returns where the inventory comes back to us and we can't resell it, or at least we can't put it back on our books at the same amount that it was when it left the door. Okay, so this is a pain. This is a pain in the neck here. Okay, along with the purchase discounts, this is one of the more difficult concepts in the chapter, but we have to deal with it. All right. So let's see, did I skip anything here? All right. So how does this work? It says when a buyer receives merchandise that is defective, damaged during shipment, or does not meet the buyer's expectation, the seller may pay the buyer a cash refund or grant a customer allowance that reduces the accounts receivable owed on the original selling price. So if you remember, Net Solutions sent some merchandise back along with a debit memo. Okay, and if this were that transaction, we would have the company, Maxim Company, they would be applying a cash refund of $900. So cash is credited because it's an asset and it's going down. Here we are. And then they had already set up this liability, right? They had already anticipated that over the course of the year, some of the merchandise that they sold would be returned. So they set up a liability to make sure that their balance sheet assets and liabilities were fairly presented. Now they're chipping away. Whenever they do this, yeah, the cash is going down, but a liability is going down too. We know that a liability is going down. Why? Because this word right here, payable. Okay? Let's see what else we have here. So, let's see here. I remember this slide. Okay, so just as a customer can issue a debit memo, a vendor can issue a credit memo. All right, so I don't really like this example. I was hoping that we would have this from Maxim, but here with the debit memo example, Net Solutions was the customer, but with the credit memo example, they're actually the seller. So I went ahead and put this picture in here, and there was a mistake here. This says this should be credited. This is worded incorrectly here. So what we have here is we have a company called Blake & Sons. I want you to try to keep up with what's going on here. Blake & Sons, they probably sent a debit memo to Net Solutions and said, hey, you messed up our order to the tune of $900. They don't always issue a debit memo. They might have just called and complained, and Net Solutions says, yeah, sorry about that. Put it in a box, send it back, and we're going to credit your account. Okay, we're going to give you a credit. All right, so $900, allowance for merchandise damaged in shipment. So this is an example of a credit memo. Our previous example was a debit memo. Debit memos are issued by the buyer. Credit memos are issued by the seller. All right. So this is how it would look on the books, because Net Solutions did not issue a cash refund. Why? Because they never got the money in the first place. Blake & Sons hasn't paid them yet, so it would be inappropriate for them to issue a cash refund. So what they're going to do is they're going to debit their liability account, customer refunds payable, for $900, okay? And they have this asset account, accounts receivable, that's the controlling account. Blake & Sons, you add that on there. That's the subsidiary portion. This was set up as a debit, but now we're going to credit it $900. What are we saying here? We're saying that Blake & Sons owes us $900 less than what they originally owed us. That's what we're saying. Okay, so we have one example. Customer pays cash up front, they get a cash refund. This is a situation where the sale was made on credit, so we can't give them a cash refund. They never have paid us the cash to do so with. Okay, so we credit their accounts receivable. All right, let's see here. Another example dealing with customer returns. It says, assume that on January the 15th, Borman Enterprises returned merchandise with a selling price of $3,000 for a cash refund. So they had paid for the merchandise. Let's see here. The merchandise originally cost Net Solutions $2,100. Net Solutions would record the cash refund and the return with the following two entries. Okay, so let's think about what's going on here. Borman returns the merchandise, which they paid $3,000 for. Net Solutions is like a middleman. They paid $2,100 for that. So the first thing that we have to do is we have to reduce our liability, our customer refunds payable that we set up, by the $3,000 that we received. In this case, we're just going to issue we're going to issue Borman a cash refund of $3,000. So Net Solutions is giving a cash refund of $3,000, so cash is going down by $3,000. Now let's just say that there was nothing wrong with this merchandise. Nothing wrong with the merchandise. Keep it simple. Just maybe the wrong color, wrong whatever. They paid $2,100 for it, so now they're getting that inventory back. Originally, they credited this inventory when they sold it, but now they're getting it back, so they're putting it back on the books, back on the balance sheet at $2,100. Okay? And we are crediting estimated inventory returns. So I want to go back real quick here if I can. We set estimated inventory returns up with a debit. And now, as we have some returns, we are crediting estimated returns inventory. Okay? One more slide and we'll take a break. Here is just a little bit of a recap of the journal entries to record customer refunds, allowances, and returns. Okay, we don't have any figures here, but you can look this over and it says, if the customer does not return the merchandise, customer returns the merchandise, what all is taking place. Has the customer paid for the merchandise? Did the customer buy the merchandise on credit and is returning all or part of the merchandise before paying? And so we've got these 4 examples here. All right. Okay, this video is getting a little bit long, so we're going to stop this one here and we'll pick up with a couple more and close this chapter out.